Have ETFs become too complicated? The first ETF, which stands for Exchange Traded Fund, was actually launched about 30 years ago now. Initially, they were simple in design, and you generally bought them because they held a set group of stocks or bonds using an index and charged a low fee. Today, though, there are now over 4,000 ETFs that are listed on the New York Stock Exchange. Interestingly, this is more than the 2,400 individual stocks listed on the exchange. In 2024 alone, 700 new ETFs were launched, and 33 of those tracked cryptocurrencies. Frankly, I wouldn't be surprised to see this continue to grow over time. The assets have now ballooned to $11 trillion and account for 1/3 of money invested in long-term funds. Some of that growth has come from open-ended mutual funds, which have lost $1.2 trillion in the past 2 years. There are now 1,300 active ETFs, which actually manage the portfolio for you like a mutual fund does. A big difference, though, is those funds can now be sold during market hours, or with the open-ended mutual fund, you have to wait until the close of the market, and then you sell those shares at the closing net asset value for the day. Nearly half of the 1,300 active ETFs were launched last year alone. It gets difficult, though, for investors with over 4,000 choices to decide which fund is the best to choose. Interestingly, back in 2020, Cathie Wood grew to fame with her actively managed ARK Innovation ETF. The fund shot up 150% that year, and assets hit $28 billion. You have to be careful, though, as looking at that fund compared to the NASDAQ has a 5-year cumulative return of 108%, and the ARK fund has actually seen a decline of 2%, and the assets are now under $7 billion. If you're investing in an ETF to benefit from commodities, understand that generally they use future contracts to track the underlying commodity. And commodity futures are not necessarily a perfect vehicle, and they generally work better for speculators that do short-term trading. One exception to this, though, is the SPDR SPDR Gold Share ETF, which is a trust that holds the actual gold. In my opinion, it is far easier to analyze one company to invest in and then build a portfolio rather than trying to understand some of these ETFs that can use leverage or future contracts or whatever, frankly. I worry investors, unfortunately, could be blindsided when they least expect it, as many of these products have not been tested during difficult market times. I'm Chase Wilsey with Wilsey Asset Management. If you like these videos, be sure to give it a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.